Hi everyone, Rodrigo Diaz here coming at you with a very fun presentation about a very interesting topic. We're going to be talking today about interest rate parity condition. I'm going to get into some definitions in a little, well, we're just going to get into all of it right now because it is a little dense. It's kind of hard to get a grasp on it, but once you understand every moving part, it's kind of easy to see it in action. And hopefully I can clearly portray that for you here today. Start off with some definitions, like I said. We're going to go into interest rate parity in a little bit. First, we're going to go over some of the easier topics like domestic and foreign currencies. For the sake of simplicity in this presentation, domestic currency is going to be US dollars and foreign currency is going to be euros. But you can think of it as trading between US dollars and yen, pesos, anything real. Or you can think of it as trading yen and Mexican pesos. One of the definitions that I forgot to put up here is going to be about global mobility. It's about how foreign markets internationally just are supposed to work together and gel. Moving on from there, the spot exchange rate versus the forward exchange rate. Spot exchange rate would be the exchange rate that you get if you were to trade a dollar into a euro today. The exact exchange rate up right now, but we can always look that up later on our own. It's going to change constantly anyway. The forward exchange rate is the rate of exchange which is agreed upon right now for a foreign exchange market transaction that will occur at a specified date in the future. Going on from there, we're going to look at appreciation versus depreciation, which is another simple one. It's just whether a currency is appreciating, the value of it is going up compared to other currencies around the world, or if it's depreciating and its value goes down compared to the global market. Starting to get into the complicated stuff here, something that's very relevant to interest rate parity would be arbitrage. Arbitrage is defined as the simultaneous buying and selling of securities, currencies, or commodities in different markets or in derivative forms in order to take advantage of differing prices for the same asset. One of the best ways I can break that down is that arbitrage is basically taking advantage of an investment opportunity that minimizes or completely eliminates the risks that you would experience in a normal financial market. And that moves us into the main topic, which is interest rate parity. Interest rate parity exists to prevent arbitrage from existing when trading currencies between two different countries. So I'm about to get into some examples. One of the simplest ways to think about this is think about storing your money in a U.S. bank in U.S. dollars. You get a nominal return of 5%, right? Or an interest rate of 5%. In a foreign bank, say in Germany, you can store your money and there's a nominal return of 6%. There's obviously an incredible incentive to just move all your money to a German bank to get a higher nominal return. And then vice versa if the higher nominal return is in the United States. Interest rate parity exists to prevent that by taking into account the foreign exchange rate as well as the interest rates that you may gain from an investing opportunity. So this graphic here has a good way of showing it. It shows the differing exchange rates, and the differing interest rates are supposed to even out. Debits and credits, they're supposed to zero out so that when you make the investment either in US dollars or in euros, you're going to end up with the same amount of money. One of my favorite examples that I was able to find has to do with buying treasury bills. So say you want to purchase a English treasury bill that has an annual interest rate that comes back at 2%. And the US is offering interest rates at 1%. Obviously, you're going to want to go for the higher annual interest rate, so you're going to invest your money in, I guess now we're going away from euros. Anyway, it goes into British pounds, sterling, or whatever they call it. And so say you just invest your dollars and then get that interest rate, that's arbitrage, and you're basically eliminating any kind of risk that you were supposed to initially take on with your investment. Once the foreign exchange rate takes into account that amount of money that you're making, and it's basically just giving you that same interest rate that you would have gotten in US dollars. I'm trying to keep this to 5 minutes, so that's the most bare bones explanation that I could give for this topic. I hope that was sufficient. I hope everybody kind of understood what I was trying to get at. I'm excited to read your comments. I hope they're thought provoking because I'd love to explain a little more. I did a lot of research on this and there's like a lot that was left out. So feel free to leave comments and I'll be very happy to reply. Have a great day, everyone.